Almost at the end of the World Economic Forum here in Davos, Mark Carney, the Bank of England governor, said that the UK was coming towards the end of the first phase of forward guidance. It's the first time he's ever used the phrase first phase for forward guidance, so it obviously raises the question, what are the other phases? What are the phases to come? And from his speeches here and from other Monetary Policy Committee members, we can really have quite a good idea where the debate is in the Bank of England. I think the first option they have is to reduce the 7% unemployment threshold to a number lower than that, say 6.5%. But I'm pretty sure that's not going to happen. You wouldn't be talking about different phases if that was the case. And also Martin Weir, one NPC member, has said that that wouldn't have a lot of credibility. So the next thing that could happen is that they might link a new form of guidance to another variable, say real wages, something like that. That's more likely because we hear them talking a lot about real wages. They didn't talk about it at all in August, not at all. But now it seems to be the big thing they care about. The third thing they could do would be to move towards time contingent guidance. And when I say time contingent, I really mean that they would say they'll keep interest rates at 0.5% for, let's say, a year or a year and a half, or till mid-2016, something like that, something very clear and very specific. We know Mr. Carney likes this a lot. It's what he introduced in Canada in 2009, and he really believes it works. Sometimes we thought that's what he was going to introduce earlier last year, last August, and he got persuaded out of it by the MPC. Now maybe that's the thing that's going to be on the agenda. And the fourth possibility is that they drop guidance altogether. I don't think that's very likely. It would look like a huge U-turn. It's enough of a U-turn that they're already going to have different phases of guidance. Then it would just look as if they didn't know what on earth they were doing if they dropped it altogether. Now, what's the purpose of these different phases? I think the real thing they want to get across is they want people to understand that interest rates are going to stay low for a long time, and even when they rise, they'll rise slowly. So they want to think about what form of guidance gets that message across best. They haven't decided yet. Maybe we'll hear on the 12th or 13th of February when they release their inflation report. But whatever happens, it's a huge change of policy 6 months after the last huge change of policy from the Bank of England. Chris Giles from the Financial Times.